Financial writers and gold bulls have both taken their turn at referring to a potential recession as having a positive impact on gold prices. The commentary varies somewhat, but here are a few examples. The price of gold would, quote, benefit from a recession, end quote. Quote, the risk of recession will drive investors into gold, end quote. Quote, a confirmed recession is all gold needs to move higher, end quote. Statements like these stem from the assumption that bad economic news is good for gold. Further, the worse the economy is, the higher the gold price. That is simply not true. A recession is a descriptive term for a slowdown in economic activity. The term overheated economy also refers to higher elevated economic activity. Economic events are different from financial events. The stock market crash in October 1929 was a financial event. The Great Depression that followed was an economic event. Recessions and depressions are terms that refer to weak and depressed economic activity. Conversely, when people use the term overheated economy, they are also referring to economic activity. Gold is a financial asset. Its price is not determined by economic events or activity. During the period 1934 to 1970, the United States and the rest of the world experienced a horrible depression, a horrific world war, and a period of new and positive growth, economically speaking. For 36 years, the inflation-adjusted price of gold declined steadily. This seems to contradict those who insist that things like a weak economy and geopolitical interest are good for gold. Then, between 1980 and 2000, the United States and the world economy experienced probably the most significant and lasting period of unusually strong economic growth in history. Technological advancement and business expansion powered a growth juggernaut. Inflation, or more correctly, the effects of inflation, were little noticed. The inflation-adjusted price of gold declined by more than 2/3. The nominal gold price declined similarly, as much as 70% from its intraday peak to its low point 2 decades later. The price of gold is not affected or determined by economic events such as recessions, depressions, etc., nor is the gold price subject to considerations involving wars, political instability, interest rates, etc. The only determining factor in the increasing price of gold over time is the actual loss in purchasing power of the US dollar. That loss in purchasing power is the effect of inflation which was created previously by the Federal Reserve.